Hey everyone, and welcome back to the Deep Dive. Today we're going to be digging into a really interesting question that one of our listeners sent in about minimizing taxes when you decide it's time to sell your home.
Oh, yeah, this is something that could potentially save you a lot of money.
For sure. And we actually found a fantastic article from the Skloff Financial Group that goes into some of the strategies you can use.
Yeah, it's called How to Legally Avoid Taxes When Selling Your Home Part 3, and it really lays things out nicely.
So let's dive in. One thing that stood out to me right away was how many people might be miscalculating their profits when they sell.
Absolutely. A lot of people just assume that it's a simple subtraction problem.
Right. Take the sale price.
Subtract the original purchase price and boom, there's your profit.
But it turns out there's a pretty crucial piece missing from that equation.
It's true. There's this thing called your adjusted basis, and it can have a huge impact on how much you actually end up owing in taxes.
Okay, on all ears, what is this adjusted basis all about?
So basically, it starts with what you originally paid for the house, but then you also factor in any major improvements or renovations you've made over the years.
Gotcha. Like if you remodeled the kitchen or put on a new roof, those expenses could affect your adjusted basis?
Exactly. The article actually uses the example of someone who spent $20,000 on a bathroom renovation and another $30,000 updating their kitchen.
So in that case, if they originally bought the house for, say, $200,000,
Then their adjusted basis would be $250,000.
not just the original $200,000 purchase price,
Right. And having that higher adjusted basis means that you end up with a smaller taxable profit when you sell.
which translates to lower taxes.
Yeah.
I'm starting to see why this is so important.
It really can make a huge difference, especially if you've done a lot of work on your home over the years.
And this is where it gets even more interesting because the article points out that the length of time you own your home before selling can also drastically affect your tax burden,
Definitely. There are actually three scenarios they outline.
starting with what they call a short-term gain, which applies if you sell within a year of buying.
So basically, a quick flip.
Right. So what happens in that case tax-wise?
You'd face the highest possible tax burden, which would likely be a combination of your regular income tax rate plus something called the net investment income tax, or NIIT for short.
Wow, that doesn't sound good. How much are we talking about here?
Well, they use a hypothetical profit of $500,000 as an example, and in that case,
Okay.
you'd be looking at a whopping $194,000 in taxes.
Ouch. That's a serious chunk of change. It definitely seems like holding onto the property longer can make a big difference.
Oh, absolutely. So the second scenario is what they call a long-term gain.
Which means,
You've owned the house for at least a year, but less than 2 years before selling.
okay, so you're still not holding it for a super long time, but it's longer than a quick flip.
Right. And in this case, the tax burden is lower. In our $500,000 profit example, the tax bill would drop to $119,000.
Yeah, okay, so still a significant amount, but way less than the $194,000 we saw with the short-term gain.
It's a huge difference.
But I have to admit, I'm most intrigued by that third scenario, the one where you might not have to pay any taxes at all.
Ah, yes, the sweet spot where you potentially pay zero taxes. This is where things get really exciting.
Tell me more. How does that work?
Well, if you've owned the house for at least 2 years and you meet certain eligibility requirements, you could completely eliminate your capital gains and NIT liability.
No taxes whatsoever. That sounds amazing. But what are these eligibility criteria we need to know about?
We'll dive into all those juicy details in the next part of our deep dive.
You got me on the edge of my seat, but before we move on, I think it's important to really emphasize just how big of a difference these scenarios can make to your final profits.
I agree. We're talking potentially tens of thousands of dollars in savings.
In that $500,000 profit example, we've been using the difference between selling within a year and holding onto the property for at least 2 years, and meeting those eligibility criteria is a whopping $194,000.
Yeah, it's incredible how much of an impact those factors can have.
So listeners, paying attention to your adjusted basis and how long you plan to stay in your home could seriously pay off when it comes time to sell.
It's definitely worth thinking about strategically.
We'll be back with part 2, where we'll unlock the secrets to meeting those eligibility requirements for the capital gains exemption. So stay tuned.
Can't wait.
Welcome back to our deep dive, everyone. So last time we were talking about this idea of a sweet spot when selling your home.
Right, where you could potentially avoid paying any capital gains taxes.
It sounded almost too good to be true. So let's
Yeah.
break it down and see how you actually qualify for that.
Okay, so the key here is meeting something called the eligibility test, which basically boils down to two main things:
All right, lay it on me.
ownership and use. You need to have both own and use the home as your primary residence for at least 2 out of the 5 years leading up to the sale.
So it's not enough to just own the property on paper. You actually have to have lived there as your main home.
You got it. The IRS wants to see that you weren't just using it as a rental property or a quick investment flip.
It has to have been your actual home.
Yeah, for a significant period of time.
So let's say, for example, I lived in a house for a year, then rented it out for the next year, and then moved back in for another year before selling. Would that qualify?
That's a tricky one. And it really highlights why it's so important to understand all the details of this eligibility test.
Because it's not always as straightforward as it seems.
Right. In that scenario, you might not actually meet the requirements because your use as a primary residence wasn't continuous for those 2 years.
It seems like there's definitely some room for interpretation there and potentially some gray areas.
Exactly. And that's why it's always a good idea to talk to a tax professional if you have any questions about your specific situation.
They can help you figure out if you meet the criteria and make sure you're doing everything correctly.
Absolutely. It's better to be safe than sorry when it comes to taxes.
Especially when we're talking about potentially saving thousands of dollars. So besides just waiting longer to sell, are there any other proactive steps homeowners can take to try to minimize those taxes?
Definitely. One thing that's super important is meticulous record keeping. Remember we talked about those capital improvements that can increase your adjusted basis?
Like if you renovated the bathroom or put in new flooring?
Exactly. Well, documenting those expenses is crucial.
Because those receipts could end up saving you a lot of money come tax time.
That's right. It's not just about those big renovations either. Even seemingly small improvements can add up over time if you've got the receipts to prove it.
So it's like a treasure hunt around the house.
Kinda. You never know what might come in handy.
All right, so we've got record keeping done. What else?
Well, another thing to consider is timing. Think about how the timing of your sale might align with other big life events that could affect your tax bracket.
Okay, like what do you mean?
Well, for example, if you're getting close to retirement and you expect to be in a lower tax bracket, it might be advantageous to wait until then to sell your home.
Well, that's interesting. So it's not just about the holding period itself, but also about strategically timing your sale to potentially lower your overall tax liability.
Exactly. It's about taking that broader view and thinking a few steps ahead.
And this is where having a good financial advisor can really come in handy, right?
Absolutely. They can help you analyze your individual situation and figure out the best approach for your specific financial goals.
It's like having a coach in your corner to guide you through the process.
Exactly. So before we wrap up this part, let's just do a quick recap of the key takeaways here.
Okay, sounds good. What are the must-knows for our listeners?
Well, first off, remember that your adjusted basis is crucial. Make sure you're factoring in those home improvement expenses because they can significantly reduce your taxable profit.
Right, and don't forget about the power of time. Even waiting just a year or two longer to sell can make a huge difference in your tax burden.
And of course, if you can hit that sweet spot of 2+ years and meet those eligibility requirements,
You could walk away with zero taxes on your profit.
it's definitely a goal worth striving for.
So listeners, knowledge is power. Arm yourselves with information, and don't be afraid to seek guidance from those experts who can help you navigate this complex world.
It's all about making informed decisions and setting yourself up for success.
Welcome back to the deep dive, everybody. We're ready for the final part of our exploration into minimizing taxes when selling your home.
I think it would be good, before we wrap up,
Yeah.
to clear up some common misconceptions about this whole thing.
I like that myth-busting time.
Exactly. So one that I hear all the time
Okay.
is this idea that you can just completely avoid capital gains taxes by rolling the profit from your sale into a new, more expensive house.
So basically, as long as you're trading up in the market, you're good to go.
Yeah, that's the myth.
Yeah.
But unfortunately, it's not quite that simple.
I had a feeling things are rarely that easy when it comes to taxes.
Right. So while that kind of strategy might have been more common years ago,
Okay.
under current tax law, it's not really a thing anymore.
Are there any exceptions at all, or is that just totally out the window?
There are a few specific exceptions, like, for example, 1031 exchanges for investment properties.
Right.
But even those come with their own whole set of rules and complexities.
So it's not a foolproof way to avoid those capital gains taxes.
Not at all. It's definitely worth doing your research or talking to a tax professional.
Okay, good to know. What other misconceptions should people be aware of?
Well, another common one is that just living in your house for 2 years automatically qualifies you for the full capital gains exclusion.
We're talking about that $250,000 for individuals or $500,000 for married couples, right?
Exactly. And then, it makes sense why people would think that.
Right, because we've been talking about how important that 2-year ownership period is.
But as we discussed earlier, it's not just about owning the property for 2 years. It's about meeting all those specific eligibility criteria.
You have to have both owned and used the home as your primary residence for at least 2 of those 5 years.
Right. It's a little more nuanced than just the time frame alone.
Exactly. You have to really demonstrate to the IRS that this was truly your home. So listeners, don't assume you're automatically in the clear just because you lived there for 2 years. Make sure you double-check those requirements.
I couldn't agree more. It's always better to err on the side of caution when it comes to taxes.
All right, as we wrap up this deep dive into minimizing taxes when selling your home,
Yeah.
any final words of wisdom for our listeners?
Well, I think the biggest takeaway is that you don't have to navigate this alone.
Yeah, that's so important.
There are resources available to help you.
Absolutely. Like we've mentioned before, a financial advisor or tax professional,
Can be invaluable.
they can help you make sense of those sometimes confusing tax laws and make sure you're taking advantage of all the strategies that might apply to your situation.
Exactly. Knowledge is power, right?
I totally agree. And it can lead to some pretty significant savings when it comes to taxes.
For sure. Well, I think we've covered a lot of ground today.
Yeah, we have. Thanks for all the insightful information. I know our listeners are going to find this super helpful.
It was my pleasure. I always enjoy talking about this stuff.
And remember, everyone selling your home doesn't have to be a stressful tax nightmare.
Not at all.
With a little planning and the right guidance, you can potentially save yourself a lot of money and make the process a whole lot smoother.
That's the goal.
Thanks for joining us on the Deep Dive. We'll catch you next time for another deep dive into a topic that matters to you.
See ya!